Chapter 2. Party Like It's 1999.
The late 1990s were exciting times. It was a period of immense change and innovation where the boundaries of what was possible seemed to expand daily. The internet, once a niche technology, was becoming mainstream. It was no longer just a tool for academics and researchers. It was entering homes and businesses, transforming the way people communicated and accessed information. People were excited about its potential. The idea that you could connect with anyone, anywhere in the world was revolutionary. It sparked imaginations and inspired countless innovations. It felt like anything was possible. The air was thick with optimism and the belief that technology could solve many of the world's problems. This time of optimism was called the dot-com bubble. The stock market was booming and tech companies were at the heart of this financial frenzy. The internet promised to change everything. Businesses saw huge opportunities. They envisioned a future where every aspect of life could be enhanced by this new technology. They wanted to be part of this new world. Entrepreneurs and innovators were eager to stake their claim in the digital frontier. Companies were starting up everywhere, eager to get online. From small garages to bustling offices, the spirit of innovation was palpable. There was a gold rush mentality. Everyone was in a hurry to launch the next big thing, to be the first to market with a groundbreaking idea. Everyone wanted to get rich quick. The allure of instant wealth drove many to invest heavily in tech startups, often without fully understanding the business models. Investors poured money into dot-com companies. Venture capitalists were eager to fund the next potential giant, hoping to strike gold. They believed these companies would be the next big thing. The excitement was contagious, and the market seemed to have no ceiling. This period was marked by a belief in a bright future. The possibilities seemed endless, and the potential for growth was unprecedented. The world was changing rapidly, and technology was at the forefront of this change. It was a time of big hopes, where dreams of a digital utopia felt within reach. The internet was new and unfamiliar. People didn't fully understand it, but they knew it was powerful. It was changing the way we communicated and accessed information. Businesses saw the potential of this new technology. They could reach more customers online. They could sell products and services in new ways. The internet was a game changer. Companies like Amazon and eBay emerged. They offered new ways to shop and do business. Traditional businesses felt the pressure to adapt. They too started investing in online platforms. The internet was breaking down barriers. It was connecting people and businesses across the globe. This created a sense of a global village where everyone could participate. The dot-com boom was fueled by innovation and speculation. New companies were emerging every day, each with a unique idea. The 1990s were a time of rapid technological advancement and boundless optimism. Entrepreneurs and tech enthusiasts were eager to capitalize on the burgeoning internet landscape. Some of these ideas were brilliant, while others were questionable. The atmosphere was electric, with brainstorming sessions and late-night coding marathons becoming the norm. The tech community was buzzing with excitement, and the possibilities seemed endless. Companies like Netscape and Yahoo became household names. They were pioneers in the digital frontier, setting the stage for the internet revolution. Their innovative products and services captured the imagination of millions, making them iconic symbols of the era. They rode the wave of internet adoption. Their stock prices soared, making some investors very wealthy. The stock market was on fire, with tech stocks leading the charge. Investors were eager to ride the wave of this new digital economy, hoping to strike it rich. Investors were eager to get in on the action. They poured money into any company with a .com in its name. The frenzy was palpable, with everyone from seasoned investors to everyday people looking to cash in on the internet boom. Valuations skyrocketed, even if the companies had no profits to show. The market was driven by speculation and the promise of future growth. Many companies went public with sky-high valuations, despite having little to no revenue. This period was characterized by a get-big-fast mentality. Companies focused on growth over profitability. The mantra of the time was to capture market share at all costs, with the belief that profits would follow. They believed that market share was the key to success in the new economy. The competitive landscape was fierce, with companies racing to outdo each other and secure their place in the digital future. The dot-com boom was a time of unparalleled ambition and risk-taking, forever changing the business world. With so much money flowing into the market, companies went on a spending spree. They hired aggressively, offering extravagant perks to attract talent. Marketing budgets ballooned as companies competed for attention. Companies spent lavishly on Super Bowl ads and other marketing campaigns. They threw lavish parties and offered stock options to employees. The goal was to create hype and attract more investment. This reckless spending was unsustainable. Many companies were burning through cash faster than they could generate revenue. They were building their businesses on shaky foundations. The dot-com bubble was a time of excess. Companies and investors alike got caught up in the hype. They believed the good times would last forever. Section 5. Warning signs. Cracks start to show. As the dot-com boom reached its peak, warning signs began to emerge. Some analysts questioned the high valuations of internet companies. They pointed out that many of these companies had no clear path to profitability. Alan Greenspan, then chairman of the Federal Reserve, warned of irrational exuberance in the market. He cautioned that investors were getting carried away by speculation. Despite these warnings, the party continued. Investors remained optimistic, believing that the internet would change everything. They continued to pour money into dot-com companies. However, the cracks were starting to show. Some dot-com companies began to lay off employees. Others were forced to shut down altogether. Section 6. The bubble bursts. Reality bites hard. In early 2000, the dot-com bubble finally burst. The Nasdaq, a stock market index heavily weighted towards technology companies, began to plummet. Investors panicked, selling their shares en masse. The collapse was swift and brutal. Many dot-com companies went bankrupt. Countless investors lost their savings. The dream of getting rich quick had turned into a nightmare. The dot-com crash exposed the flaws in the market. Companies had been overvalued. Investors had been too eager to believe the hype. The fundamentals of business had been ignored. The crash was a wake-up call. It reminded everyone that even in the age of the internet, sound business practices still mattered. Section 7. Picking up the pieces. Lessons learned. The dot-com crash was a painful experience, but it also provided valuable lessons. Investors learned the importance of due diligence. They realized that not all dot-com companies were created equal. Companies learned the importance of building sustainable businesses. They realized that growth for growth's sake was not a viable strategy. Profitability mattered. The crash also highlighted the importance of regulation. Some argued that the lack of oversight contributed to the excesses of the dot-com bubble. The lessons of the dot-com bubble are still relevant today. They remind us that even in times of rapid technological change, the fundamentals of business remain the same. Section 8. Echoes of the past. Are we repeating history? The question of whether we are repeating history is more relevant now than ever before. As we look back at the tech boom of the 1990s, we see a period of immense growth, innovation, and ultimately a dramatic crash. The echoes of that era seem to resonate in today's tech landscape. In recent years, there have been growing concerns that we are in another tech bubble. The rapid rise in valuations for tech companies has sparked debates among investors, analysts, and industry experts. Are we on the brink of another collapse, or is this growth sustainable? Valuations for some tech companies have skyrocketed to unprecedented levels. Companies that were once startups are now giants, commanding market capitalizations in the billions. This surge in value has been driven by a combination of technological advancements, investor enthusiasm, and the promise of future growth. Investors are once again pouring money into startups, hoping to find the next big thing. Venture capital is flowing freely, and new companies are emerging at a rapid pace. The excitement is palpable, reminiscent of the dot-com era when everyone was eager to invest in the next potential tech giant. There are certainly parallels between the dot-com bubble and the current tech landscape. Both periods are characterized by rapid innovation, high investor interest, and soaring valuations. However, it's crucial to understand the nuances and differences that set these two eras apart. However, there are also important differences. Unlike the 1990s, today's tech companies are generally more mature. They have established themselves in the market, built strong customer bases, and developed robust business models. This maturity provides a level of stability that was often lacking during the dot-com bubble. Today's tech companies are generally more mature. They have weathered various market cycles and have proven their resilience. Many of these companies are not just surviving but thriving, with substantial revenues and profits to show for their efforts. They have proven business models and generate significant revenue. This financial strength is a key differentiator from the 1990s, where many companies were valued based on potential rather than actual performance. Today's tech giants have the numbers to back up their valuations. Nevertheless, it is important to be aware of the risks. The market can be unpredictable, and high valuations can sometimes lead to overconfidence. Investors must remain vigilant and consider the potential downsides of their investments. Investors should be cautious and avoid getting caught up in the hype. It's easy to be swayed by the excitement and potential of new technologies, but it's essential to conduct thorough research and make informed decisions. Blindly following trends can lead to significant losses. Companies should focus on building sustainable businesses with sound fundamentals. Long-term success requires more than just innovation. It demands solid financial planning, effective management, and a clear vision for the future. By prioritizing these elements, companies can navigate the complexities of the tech market. History may not repeat itself, but it often rhymes. The lessons from the past are invaluable, offering insights into the potential pitfalls and opportunities of the present. By studying the dot-com bubble, we can better understand the dynamics at play in today's market. By learning from the past, we can make better decisions in the present and avoid repeating the mistakes of the dot-com bubble. The key is to remain informed, cautious, and strategic in our approach to investing and building businesses. In doing so, we can create a more stable and prosperous tech industry for the future. Section 9, The Future is Now, Building a Sustainable Tomorrow. The dot-com bubble was a period of both great innovation and great excess. It taught us valuable lessons about the power and the perils of technology. As we move forward, it is important to remember these lessons. The internet continues to revolutionize our world. New technologies are emerging all the time. It's an exciting time to be alive, but we must proceed with caution. We must avoid the mistakes of the past. We must build businesses that are both innovative and sustainable. By focusing on the fundamentals of sound business practices, we can harness the power of technology to create a better future for all.